Which of the big four Chinese banks should you invest in? Let us break it down for you. Money makes the world go round, and for a long time, the financial industry has been the main industry in most exchanges around the world. And banks are among the most common investment for investors. And today, the largest bank in the world by asset size are all located in China. Today, let's talk about the 4 biggest banks in the world and what you need to know about them before investing. Firstly, let's talk about what is similar among them. The big 4 Chinese banks are all dual listed on the Hong Kong Stock Exchange and the Shanghai Stock Exchange. So we can invest in them either through the Hong Kong market or the Shanghai market. But the denominated currency will be different. Secondly, all 4 banks are what we call state-owned enterprise, or SOE in China. These are companies mainly owned by the government, and thus one of the key risks investors need to take note of when investing in Chinese banks is the political risk. This is because sometimes the bank might choose to follow certain strategy of the government for reasons of national security. And those sections might be at the expense of shareholders. However, political risk is always a risk when investing in any stock in China, and even more and more so in the US market as well. Thus, this is something that investors just need to take note of. Next, let's dive into each of the banks in detail. Let's start with the Industrial and Commercial Bank of China, or ICBC. ICBC is the largest bank in the world by asset size. It has an asset size of renminbi $30.1 trillion at the end of 2019. It generated a revenue of renminbi 776 billion and a net profit of 312 billion last year. The bank has shown good, consistent growth over the years. Its revenue has been growing at about 8.2% a year over the past 3 years, and its net income has grown about 3.9% a year over the same period. Even though it is such a big bank, the majority of its revenue is still coming from mainland China. Only 8% of its revenue is coming from overseas. In terms of its loan breakdown, 60% of its loan is given out to corporate clients, and mostly in the transportation, logistics, and manufacturing sector. 38% of the loan is given out to retail clients, of which mostly are tied to property mortgages. The bank is also quite well managed. Its non-performing loan ratio is capped at just 1.43%. Non-performing loan ratio is a measure of how much bad debt the bank has in comparison to its total loan portfolio. Therefore, having a low NPL ratio is better for the bank. And ICBC has also managed to generate a return on equity of about 13%. ROE is a measure of how efficient the bank is in generating profit for shareholders. If you want to know more about what does ROE means, you can check out our other video right here. And that's some of the important things we need to know about ICBC. Now let's look into the China Construction Bank. China Construction Bank is the second largest bank in the world by asset size. It has an asset of about 25.4 trillion renminbi at the end of 2019. It generated a revenue of 678 billion renminbi and a net profit of 269 billion renminbi last year. Its revenue is growing at about 5.25% a year over the past 3 years, and its net profit has grown about 4.8% a year over the same period. And that's slightly faster than ICBC. Compared to ICBC, it is an even more China-focused bank. Only 2.5% of its revenue is coming from overseas. In terms of their loan breakdown, it has a more balanced loan profile. 46.3% of its loan is given up to corporate clients, and mostly again with the transportation, logistics, and manufacturing sector. 43% of its loan is given out to retail, which is also predominantly in property as well. In terms of efficiency, again it's very similar to ICBC. Its non-performing loan ratio is as low as 1.42%, and it has a ROE of 13.18%. That is the highest among all the 4 banks. So if you're looking for a better managed bank, ICBC or CCB should be in your watch list. Next is the Agricultural Bank of China, or ABC. ABC is the third largest bank by asset size. It has an asset size of about 24.9 trillion renminbi at the end of 2019. And from that, it generated about 629 billion in revenue and 213 billion renminbi in profit. Its revenue and profit is growing healthily. Its revenue is growing at about 7.4% a year over the past 3 years, and its net profit grew about 4.8% a year at the same period. Again, ABC is a China-focused bank with only 6.5% of its revenue coming from overseas. 53% of its loan is given out to corporate clients and 40% to the retail market. And its loan profile is very similar to ICBC and CCB. In terms of efficiency, its non-performing loan ratio stands at about 1.4%, and it achieved an ROE of 12.4% in 2019. Lastly, let's talk about Bank of China, the smallest among the four. Although Bank of China is the smallest among the four banks, it is still the fourth largest bank globally. It has an asset size of about 22.8 trillion renminbi in 2019. However, its revenue is slightly lower than its peers at only 550 billion renminbi. Its net income for the year was 202 billion renminbi. Both its revenue and profit is growing at about 4.4% a year over the past 3 years. But this is where Bank of China starts to differ from the three other banks. 61% of its loan is given out to corporate clients, but its loan profile focuses more on the commerce and service sector rather than transportation and logistics. And it can also be considered as the most international bank among the four. Although only 4.2% of its revenue is coming from overseas directly, 20% of its revenue is coming from its Hong Kong, Macau, and Taiwan business. And this is due to its 66% ownership of its listed subsidiary, Bank of China Hong Kong. And Bank of China Hong Kong is one of the biggest banks in Hong Kong, which serves a more international market. Its non-performing loan ratio is on par with its peer at 1.37%, but it has a much lower ROE at just 11.45%. So these are the key important aspects of the four banks. You can see that they are all quite similar in terms of their business and risk exposure. Therefore, maybe a good way to compare them might be just to look at their valuation. For banks, I like to use the price to book ratio and its dividend yield. A price to book ratio is a measure of how expensive the stock is relative to its net asset. And thus a lower ratio would mean that the bank is more undervalued. And the dividend yield is just the dividend return that we will be getting when investing in the bank today. Therefore, a higher yield will be better for us. In terms of its price to book ratio, we can see that all four banks are trading at very low valuation, with Bank of China at the lowest and the China Construction Bank at the highest end. Next, we can look at its dividend yield. We can see that all of them are giving out very attractive dividend yield for investors, with Bank of China again giving the highest yield at 7.6%. I see banks as just a proxy to its economy, and Bank in China is mainly tracking the traditional industry of China. And that's why I see them as maybe slow growing income stocks rather than growth stocks. As a business, I have no preference over any of the banks as I see them as quite similar to one another. However, out of the four, I ended up investing in Bank of China, mainly due to its highest exposure to the international market as well as its higher yield. But before I go, I'd like to touch on a key risk facing the four big banks today, and that is the threat of fintech in China. Due to the fast-growing infrastructure that is growing in the mobile banking segment, I feel that mobile wallets like Alipay and WeChat Pay are so big now in China that they are a threat to the traditional banking industry. And given that Alipay and WeChat Pay are serving mainly the retail and the small businesses in China, they actually have a much stronger and more diversified customer base compared to the traditional banks. Ant Financial, which own Alipay, has announced its intention to list its shares both in the Hong Kong and Shanghai market soon. And its valuation could fetch as high as $200 billion in market cap. And that is a market cap bigger than even Bank of China or Agricultural Bank of China. So if you're looking to invest in banks in China, you have to watch the development of fintech space in China as well. So if it's you, would you rather invest in the banks or in companies like Ant Financials or Tencent Holding? Let me know in the comment down below. Anyway, that's it from me. If you like this video, please give us a like, and if you find it useful, please share it as well. Remember to subscribe to our channel for even more videos coming your way. My name is Stanley. Till we meet again, invest safely.